Okay, before we start, let's do a quick round of intro. Do we want to start with you, Ashna?
Thank you.
Ladies first, come on.
Hi, everyone. I'm the Chief Customer Officer at Mercuryo. I look after the customer experience at Mercuryo.
Nice. Melvis.
Hello, everyone. My name is Melvis, and I'm Executive Director at Canton Foundation. Canton is a layer 1 blockchain that was purposely built for institutional finance. We combine configurable privacy, controls, and interoperability to enable about currently like $350 billion of repos per day on the network and over $6 trillion worth of TVL across different industries.
Darius, you want to go next?
Yeah, for sure. Hey guys, here's Darius from 21 Shares. I focus on venture and research at 21 Shares. So also actually an announcement, first time we're announcing it publicly. 21 Shares is launching their first venture fund, and it's going to come out of our research team. Who is 21 Shares? We are one of the earliest and largest issuers of crypto ETPs in Europe and ETFs in the US. So we make it easy for institutional investors to get access to cryptocurrencies.
Get your pitch books ready. Andrew, I'm a risk guy. I believe in innovation with robust risk awareness and risk conversations, and to kind of pursue that mission, I lead digital asset analytics at S&P Global Ratings. So we do stablecoin stability assessments that we published, that we launched on chain last year on Base. We do ratings on tokenized funds. We recently done a rating on a Bitcoin-backed ABS deal, securitization in the US. We rate strategy, we rate Coinbase, and Sky Protocol as well. We did our first rating in DeFi last year, and yeah, more and more interested in the DeFi space.
Thanks, Andrew. I'm Francesco. I'm leading developer relation at Consensus MetaMask, and I'm excited. This is definitely like out of my comfort zone. So if you guys have any question about institutional risk or kind of like adoption, feel free to shout it out. So let's get started. So what is the state actually for on institutional risk and adoption? We can start with you, Andrew. Obviously, you've been probably like the one with most experience around risk.
Sure. So I guess at S&P we have one mantra, which is that credit is credit and risk is risk. So when we're looking at something new, and some of my let's say more mature colleagues will tell stories from when we first rated variable interest rate instruments in the 80s, and how people were very stressed about that, and it was such a very strange innovation. There's always been innovation. There's always been new risks to think about, and it's about having that ability to unlearn maybe some of the things that you've been basing your assumptions on and relearn in a different context. And so when I think about risk, I don't necessarily think about TradFi versus DeFi. I think about financial risks. I think about concentration risk, leverage, contagion risks. And when you kind of zoom out and look at it through that lens, you can then go in and see how that applies and what specific nuances are relevant in a kind of crypto or DeFi context. So I'd say what's changed really over the last 12 to 18 months, well, firstly, the team used to be me. Now there's 3.5 of us. So yeah, that's growth. But that has happened because we've seen more and more, let's say, actual transactions that are able to go live. So for several years, people were coming up with ideas that they may want to do, particularly in terms of Bitcoin-backed securitizations, for example, to see deals that actually come forward with counterparties that commit to documentation, with sufficiently large loan pools that a deal makes sense. That takes time to emerge. That takes a whole ecosystem to grow. Similarly, on the DeFi side, having that kind of governance mature in a sense that the right risk measures are in place, that you can actually start working with something from a rating perspective. So I think that's definitely been a big shift. I think we've also seen from the more traditional side of the market, tokenized funds being kind of the first kind of gateway thing, and my funds ratings colleagues have had to get very interested in this space. And then for us, when we started publishing stablecoin assessments, that was really kind of a first concrete step into the crypto space and supporting kind of engagement with crypto market participants as well. And it doesn't necessarily mean that everyone has to agree with everything we say all the time, but having those kind of more concrete conversations, saying we think this one's riskier than that one, really helps kind of generate those good conversations with the market.
Nice. What about you guys in terms of like, institutional adoption, risk, TradFi versus kind of like DeFi? What do you guys see? Is it improved?
I mean, from our perspective as an ETP ETF issuer, maybe also for the crowd, ETP exchange traded product, which is common in Europe, ETF exchange traded fund, which is more common in the US. So in the US, we have ETFs. In Europe, we have ETPs. I'm just saying it because very often people get confused.
Good. I love when people give context.
So people get confused by it. I think the risk profile for institutional investors very much changed with the emergence of ETPs and ETFs. I mean, we have ETPs in Europe since 2018. Actually, we were the first one in 2018 to launch a physically backed Bitcoin ETP. We were one of the first in January of 2004 when the US approved crypto ETFs in the US. And I think before, for institutional investors, it was more of an operational risk. So custody, private key management, counterparty risk, if you want to deal with crypto assets and tokens. And now we, with our product, so like this type of product category, abstracted all of this away, okay? So now it's more of a like portfolio risk, like what they know from traditional assets. So it's more about liquidity, volatility, correlation with other assets that they have within their portfolio. So we see a major shift in the type of risk that they're dealing with, more from, again, the more crypto native risk, which is all abstracted away by a product like ours, to more of like a general portfolio risk. Yeah.
I think for me, so I've been in the space now for 6 years, and I've seen a predominantly big change within the last 2 years, especially around blockchain analytics, transaction monitoring. So I feel that we still have a way to go, but we've improved so much in terms of risk.
For us, because we are an infrastructure provider as a layer one, and in the heart of the conversion between TradFi and crypto, we've built the network to be able to take into account the core components that are needed for institutions to come into crypto. And that entails, for example, at the granular level on our network, for example, looking at different types of assets, cash, or workflows that need to come on chain. We're taking into account the fact that for institutional players to formally enter, they need to be able to have the capabilities and awareness of how to assess market risk, counterparty risk, credit risk, and liquidity or settlement risk as well. And so in doing so, we have built the network to allow for partners who are launching applications to be able to launch those apps with the granular configurable privacy that they may need to enable some of the components around counterparty or even regulatory risk that may come up. Controls to allow for ability to have the capability around who gets to engage with the application or the asset, and then lastly, enabling the ability for interoperability so that at the end of the day, when there are assets that are being launched, they're able to trade it, get better liquidity across different platforms, and be able to get the size or exposure that they may want.
Maybe just to give a context, like let's give a big background, a bit like how you define risk. What are the kind of like the main pillars? I know it's a big, but on very high level, yeah.
So from a rating perspective, so rating is actually, full name of rating is a credit rating, and so we're looking at default risk. And so I always like to start from that explanation that it's not a kind of abstract ranking of this thing is better than that. It's really looking at, is there a risk of default on an obligation that's owed by some entity to someone else, and then looking at the factors that might drive that risk of default, so not repaying debt. So when we give an example, when we look at the Sky Protocol ratings, or our first DeFi rating, what is the Sky Protocol? Ultimately, it's a lender. It's a lender that takes credit risk on the loans that it puts out. It maintains capital to cover the risk of loss on those assets. It maintains liquidity to allow depositors to withdraw safely from the protocol, and for the protocol to withstand that. Those are conceptually factors that are very similar to like a non-bank lender in the traditional world. So when you zoom out, that gives you a framework to start thinking about it. Then obviously the way in which those risks can manifest are very different once you go into a DeFi context. But having that kind of bird's eye view to start with as to what you're getting at in terms of what's your risk. So from our perspective, it's that risk of default. From an investor's perspective, it might be the risk of loss of value in a certain position, or total loss of funds. But defining that risk in the first place, and then finding a way to finding a framework to think about how that might come about.
Easy, like you want to jump in?
Yeah,
Go for it.
So one new type of risk that has come up that many institutions or trading entities need to take into account because of crypto is smart contract risk. It's one of the key things nowadays that need to be a part of the full investment process and review. And then on top of that, when it comes to the asset itself, another core risk could be, for example, settlement risk, right? Is there enough liquidity or evaluating the counterparty that you're working with in terms of credit to make sure that, and one of the issues we have in crypto with the fragmentation of liquidity or different protocols is that what if you transact with one asset, but then the underlying is a wrapper, right? For the tokenized securities, most of them are wrappers, not natively tokenized on chain. So if insolvency happens and you're in the bankruptcy claims proceedings, like where does a token fit into that whole capital stack, right? Obviously, traditionally is the secured debt, unsecured debt, preferred shares, common shares, and then what is a token, right? So being able to understand the nature of the type of token you're owning and the amount of risk you're taking, it also comes into play. And that also ties into your mandate itself. Is the asset manager able to hold tokens or they need to hold a real asset?
Is there like some kind of like funny story like of company that are not aware about specific kind of like risk or kind of like some story that you guys said in the past? Because you're dealing with different companies, obviously on the rating side, on the, I guess, CTP listing. It's very interesting because I guess like, maybe people, especially in Web3, they're not coming and prepared enough for this type of assessments.
So I wouldn't present this as a funny story by any means, but
it could be interesting, right? Yeah.
But an interesting and I guess recent one. If you look at the Resolve hack a couple of weeks ago and how that flowed through into DeFi, I know there's a lot of focus on what happened at Resolve specifically and the security risks around the minting process, but how that then landed into bad debt in lending vaults is quite interesting because what you saw happening was there was this difference or this basically oracle mismatch between the executable price on a DEX for the underlying collateral and the price that was the oracle price in Morpho. But more to the point, you had no limit on the amount that someone could deposit of this token into some of those vaults that had listed it as eligible collateral. And so within 15 minutes, you had, I think, $6 million worth of collateral deposited into a market that had $5,000 of liquidity before that. And so that leads to bad debt. People are borrowing $5 million of USDC against collateral that's effectively worthless. And so but what happened there is really just a complete absence of control around concentration risk in a portfolio. So if you've got a vault that's got like $15-20 million in TVL, and there's no restriction on some tail token that's in your list of eligible assets going up to say $5 million, then that's an uncontrolled concentration risk, and that's there are plenty of other vaults that have those controls in place. But that's an important consideration. It's a fundamental part of just financial portfolio risk management, and not necessarily anything to do with blockchain technology or crypto. And so, yeah, maybe that's an example.
Actually, I have like two stories touching upon this, what you just asked. I think one is generally with tokenization, but also with ETFs and ETPs, which is also like some sort of wrapper. If an asset is not attractive and there's no demand, it doesn't get a better asset just because it's not tokenized or it gets an ETP or ETF. And I think a lot of projects that try to like subsidize like lack of demand by launching something like this, which we have seen a lot. And we in the research team, we make our due diligences and have to say they don't pass it. So I think that's one thing. And the other one, it's not actually from a Web3 project, what you asked, but more from a TradFi player. They were interacting with, I would say, a lower tier DeFi project. And they wanted us to launch an ETP with DeFi yield. And the core question you have, obviously, as a researcher is like, where's the yield coming from? Okay, it's a very basic question. Should be the first question with any yield product. And their answer was like, it's coming from a smart contract. Okay, so obviously we as a researcher, like we weren't like satisfied with this type of question, but also shows like the differences in like education and knowledge when it comes to this. And it's like less from the Web3 perspective, but more from the TradFi side, which they think like, okay, smart contract is like a good answer about where yield is coming from. This was like kind of a funny story.
Anything? Feel free to jump in.
I don't have any funny stories now.
No, for instance, yeah.
With risk now.
Yeah, I guess there are so many companies also like they want to get listing, they want to kind of like get credit risks, and you probably get bombarded with those type of question, and you see also like how the market, especially for like company growing fast, they're not maybe coming from actually like traditional finance. That's why like it's very interesting, right? Because yeah, especially for like listings. But anyway, how many of you guys read the EF privacy or like the EF latest kind of like mandate? Just to quick concept. Okay, I just want to say how do you think about kind of like balancing transparency and privacy? Seeing now this ecosystem is actually like carrying more and more, there is more adoption. I'm just super interesting how also even you can define risk, right? Because you probably also get bombarded by company using, I don't know, like ZK for proofs, and they're all fully private, right? And it's very hard to actually define risk on that side. But I want to understand a little bit how do we balance, especially in this ecosystem, full transparency and privacy for actually the institutional adoption, risk assessment, et cetera, et cetera.
I think it's important to be honest and transparent around trade-offs because privacy is obviously a challenge and a necessity for certain financial activities. And I'm sure Melvis will want to say a few words about this. On the other hand, you have networks such as Ethereum that are extremely well established and battle tested over a long period of time and have an established amount of liquidity supporting markets. So you're trading off potentially some of that liquidity, some of that operational resilience, going with something that might be better suited to targeting the privacy question. But understanding that trade-off becomes quite important. The point that I make also just from the ratings perspective. So what we found is that when you're assessing risk in DeFi, when you're trying to monitor the health of a DeFi protocol such as Sky, you can't really operate on a TradFi paradigm. Like in TradFi, we get quarterly reports from the company 6 weeks after their reporting date. We take 2 weeks to triage it. We take another 2 weeks to kind of process anything that might need to change. You're easily talking about 90 days after something's happened by the time the market is actually aware. In DeFi, the whole market can see risk materializing in near real time, and so that means we need to be able to do that as well. So from an operational risk surveillance perspective, it's really a new paradigm. But maybe I'll let Melvis go on privacy.
Yeah. So on our network, and just looking overall the participants that we work with, the institutions, privacy is a fundamental tenet across everything that they do. In crypto, we conflate privacy with anonymity, and with anonymity is basically accepting the output without formally seeing everything within the black box. But then as institutions, you need privacy in a need-to-know basis, in the sense that doing a transaction and then carving out the different participants within the transaction to see what they need to know when they need to know it. So components of a transaction can go to the different counterparts, the lawyers, accountants, auditors, and so on. And with that, this allows it to have the ability for selective disclosure, and then also on top of that, the ability to audit that data. And that's what's necessary. So the biggest thing with crypto and the majority of the protocols that have been proliferated initially were everything was done in a fully publicly transparent manner. And as Andrew mentioned, like if you are a regulated institution, there are regulations around either protecting your own data, protecting your client data, or if you're in a competitive industry, like in a hedge fund world, you don't want your trading strategies to be replicated by everyone else in the market. And so by having the ability to put on a position, generate alpha, but not disclose everything you're doing is very, very warranted and important. And if you come to the retail side too, I doubt many people here like to disclose their bank accounts or their salaries for everyone else to see. So those are some core things that we need to have. And it's understandable initially in the ecosystem, having everything privately transparent was the core ethos. But as we're growing, we have to try to adapt to what's needed for the largest institutions.
Maybe something I want to add on this. I think there's different levels of privacy, and a metaphor I like doing, and you just mentioned like your bank account, is that me as a, let's say, customer of a bank, I don't mind if the bank should know all the balances of all its customers so it can manage its business and risk, but I don't want another customer to know my bank balance, okay? And I also think you did a great point that in crypto, especially like from the past cyberpunk ethos, people often confuse anonymity with privacy, and there's a big difference.
Yeah, that's a good point. Yeah. I mean, I'm a bit kind of like disappointed on putting like privacy together with kind of like cyberpunk value, because there is so much work that has been done in past years around privacy on specifically to actually onboard enterprise on exactly this use case, right? And now I feel like kind of like if you're putting things together in the same box, it's kind of like counterproductive. Yeah. It was very interesting. I had a really good chat with the Aztec co-founder, and it was exactly speaking like that if you put everything in the same box, it's not true. Like actually there is, ZK is actually being developed for these specific use cases and has been advocated to actually enterprise. So that's very interesting. So we touched a bit on some metrics and some standards, but what are kind of like the main metrics, standards that you wish kind of like we started to adopting more? Give us kind of like some examples.
Standards around what?
Could be like standard of risk. Like I feel like maybe a lot of people speak about different kind of like languages, and you wish kind of like we speak about when people are, kind of like approach you guys, like there is a specific like standard of like languages or like even specific metrics. Yeah.
I guess I would put smart contract standards at the top of that. Not just, well, actually, even smart contract auditing standards. So, I mean, if you review audits from 3 different auditors, you start to see, once you peel the first layer off the onion, you start to see significant differences in their actual processes. Not necessarily that one's better than the other, but things are not necessarily comparable, and that in itself can be a shade on transparency. I think when smart contracts are trying to achieve the same thing, I think it's helpful if they're using a common standard. But yeah, that being able to some extent that's already being done, but I would say not yet enough. And I think then establishing risk standards, establishing what I guess market participants care about in terms of liquidity in DeFi, and if I add one last item to my wish list, I'd like to see, like, on the kind of let's say centralized markets, requirements on market makers to actually remain in markets.
I think for me, it's got to be 2 strong points. So one is the strong transactional data. So we need to know, institutions need to know who is behind the data. Second is reserve reporting. Does the data actually exist? So all of these are really, really essential metrics that we should be measuring, for sure.
Does this data need to be on chain, or it's fine?
Yeah, for sure. Yeah, 100%.
Actually, I just wanted to touch upon your point. Like, in my opinion, especially thinking about tokenization, I would say ideally we have like real-time on-chain risk and proof of reserve monitoring, and I would even say like connected with like liability verification. Because for example, like FTX, like I think they had like 900 million in assets, but liabilities of 9 billion. Like nobody was aware, okay? And I think especially now, since like we all believe everything's going to be tokenized and on-chain, obviously we need to make sure that the asset that the token is representing also really exists. That there is like, that's bankruptcy remote. I mean, there's like different ways you can do SPVs, independent audits. There's like many ways to solve it. And I think it's more of a like threat fighting than how you like save this. But I think that's something that's very much needed in the future. And I think it's also coming. It's just a question of time.
That's a really important point, actually. Because if you hold a crypto asset, if you hold ETH in your wallet, you're actually holding the asset. If you're holding a tokenized real-world asset, you're holding a representation of that asset. And so how that has been done and what the legal construct around it is critical, because without that it could be worthless. So you look at some of the kind of, let's say, nascent real-world asset vaults that are out there. Some of them may have tokens in there that are issued with the name of some large asset manager, but if you own a token from that vault, you have basically an informal IOU from some shell company in some sunny island somewhere. And you'd have quite a nice holiday if you wanted to go to court to enforce that claim. You might not actually get much out of the process. So having that standardized in terms of how tokenization is done from a not just a technical perspective but a legal perspective as well, I think is
yeah. And to add on to two things to add on there. In terms of standards, we're on the legal side, we're getting there slowly. A few weeks ago, within the U.S., I think the SEC shared a taxonomy about how they're gonna classify tokenized assets. So, from what Andrew mentioned, there are different levels to it. Number one, in the purest fashion, is tokenization by the issuer themselves or through a direct agent that they're working with. Tokenization through a CSD, a central securities depository, is the second component that is very strong. And then lastly, it's a third party with a SPV somewhere in the Cayman Islands or Panama or BVI. And those ones, you're not really owning the real rights and obligations and claims. It's just an IOU to the index price of the underlying. So if bankruptcy happens, you're stuck in the full structure of it. And the last part that I want to highlight, which would be great to have common standards, would be so the core value of blockchain and crypto is probably the interoperability and the composability of different assets across different products. But today, getting common standards around that is very difficult. Year over year, the biggest vulnerabilities typically happen around the bridges. And so, yeah, this is a really, really big issue and something that needs tackling.
Maybe a question, Melvin. Whose responsibility is to actually like deliver these standards? On the
So-
foundation side, on the protocol side, what do you think?
Yeah, so it would be the protocol level to have common standards for everyone building within that ecosystem to utilize. For example, within Canton itself, we are a network of networks where the private applications can easily communicate with the public applications natively, so without bridging. And then there are Canton token standards, wallet standards, and the rest are coming on. So I think it's actually from the community level, and it says that it should be developed by the community, battle tested, and implemented by the community. And the foundation is there to support the coordination across it.
If it's like multi-chain, like that's also like an interesting question, because if it's coming from the protocol level, like how you deal with actually the multi-chain standardization, right?
I mean, that's the gap, right? That's why the vulnerabilities happen, is because multi-chain, it's being developed by independent protocols or teams, and you cannot formally influence it.
I guess on the multi-chain point, that's maybe the flip side of that difference between a crypto asset and a tokenized asset. That because it is just a representation, ultimately there are issuer level controls that can be put in place to mitigate some of those cross-chain risks. So we rate 3 tokenized funds. All of them are multi-chain. All of them give the issuer the ability to kind of control tokens that have been issued, burn, reissue on different chains. Now that's a degree of centralization that's obviously quite suited to that very TradFi context, but again, it comes back to that TradFi risk that if someone goes in and was able to mint some of those tokens, and for them to have value, that would be that would lead to kind of insolvencies.
Something I wanted to add is like the misconception of liquidity if we think about like RWA sometimes, because obviously a token you can switch in a second, but if like the underlying asset is like a real estate or a loan which takes like a month to settle, like it creates like this wrong impression of liquidity, which actually doesn't exist. I think that's also something that a lot of people are not aware of, or trade, or like an issue, or like a topic that needs to be solved. Yeah.
And then also, that's a good point in the sense that if it's an asset that has an issuer behind it and is tokenized or is within the crypto ecosystem, like the sovereignty of it is basically gone. The issuer can decide what to do. And although it may say that there are 100 validators stating that there is 100 stablecoins within a vault, behind closed doors, the issuer can decide to pull back credit, censor wallets, and things like that. And that happens time and time again when like regulators reach out to Circle or Tether. They can control who has what assets.
Cool. I think we're less than 1 minute left. One quick question: like, if you guys had like unlimited social capital, and unlimited kind of like political capital, what are kind of like any policy changes or regulation that you will do, like if need to be acted in the next few kind of like months that you wish like it will happen?
Clarity ASAP. Clarity Act.
Clarity on?
The Clarity Act that it passes in the US. Yeah, because this opens like the green light for institutional investors to invest. And we sadly have those government shutdowns in the US, so which keeps it getting delayed. Yeah.
I would go for more robust risk mitigation in crypto perp markets. I think that's a key point of vulnerability in crypto markets at the moment, and that's where we're seeing real volatility risks.
I think transparency, with Mika around the corner as well, live authorization is one.
I'll go with clarity as well. It says that just gives more confidence around what you can do, what you cannot do, and it's just great signaling for builders and institutions to know what to do in the ecosystem.
Nice, that was a quick answer. Normally people are taking like 5 minutes to respond to this. Thanks so much, guys. So big round of applause for our panelists here. Thank you.